What are stock options? Stock options are financial contracts that give you the right, but not the obligation, to buy or sell a stock at a specific price, known as the strike price, within a set time frame, which we call the expiration date. Unlike traditional stock investing, where you own a share of the company, options provide a more flexible approach to participating in the stock market. They offer the potential for high returns and strategic advantages, but they also come with unique risks and complexities. So, why trade stock options? Stock options can be a valuable addition to an investment strategy for several reasons. Leverage allows you to control a large number of shares with a relatively small investment. This leverage can amplify returns but also magnify losses. Options can be used in various market scenarios, whether the market is bullish, bearish, or neutral. For instance, buying a put option can act as insurance against a stock price decline, providing a form of hedging. Furthermore, selling options can generate additional income through premiums. Let's dive into call options. A call option gives you the right to buy a stock at a specific price before the expiration date. Call options are generally used when you expect the stock price to rise. Let's explore their characteristics and use cases. The intrinsic value is the value derived from the difference between the stock price and the strike price. If the stock price is above the strike price, the call option has intrinsic value. The extrinsic value is the additional value due to factors like time until expiration, implied volatility, and market sentiment, which diminishes as the expiration date approaches. The price paid to buy a call option includes both intrinsic and extrinsic values, and is known as the premium. For example, suppose you buy a call option with a $100 strike price and a $10 premium. If the stock price rises to $120, the intrinsic value is $20. However, if the stock price stays below $100, the option could expire worthless, leading to a total loss of the premium. Call options can be used in various scenarios. Speculation allows you to profit from the price increase without buying shares if you believe a stock will rise. If you hold short positions, call options can act as a hedge against rising stock prices. Additionally, selling covered calls on stocks you own can generate additional income through premiums. Now let's talk about put options. A put option gives you the right to sell a stock at a specific price within a set time frame. Put options are generally used when you expect the stock price to fall. Let's explore their characteristics and use cases. The intrinsic value is the value derived from the difference between the stock price and the strike price. If the stock price is below the strike price, the put option has intrinsic value. Similar to call options, the extrinsic value in put options diminishes as the expiration date approaches. The price paid to buy a put option includes both intrinsic and extrinsic values and is known as the premium. Suppose you buy a put option with a $90 strike price and a $5 premium. If the stock price drops to $70, the intrinsic value is $20. However, if the stock price stays above $90, the put option could expire worthless, resulting in a total loss of the premium. Put options can be used in various scenarios. Speculation allows you to profit from the price decrease without shorting shares if you believe a stock will fall. Put options can act as insurance against a stock price decline, protecting your portfolio from losses. Selling naked puts can generate income, but it carries higher risk, especially if the stock price falls significantly. Understanding options terminology is crucial for successful options trading. Let's start with the strike price. The strike price is the specified price at which you can exercise an option. For call options, it's the price at which you can buy shares. For put options, it's the price at which you can sell shares. The importance of the strike price lies in how it determines the intrinsic value of an option. A lower strike price is generally better for call options, while a higher strike price is better for put options. When selecting a strike price, consider factors like your market outlook, the risk you are willing to take, and the premium you are paying. Next, the expiration date. The expiration date is the date by which an option must be exercised or it expires worthless. It plays a crucial role in determining the option's value. Time decay, or theta, means that as the expiration date approaches, the extrinsic value of the option diminishes. This can work for or against you depending on your position. When selecting an expiration date, consider your investment timeline, the expected market movements, and how long you're willing to hold the option. Lastly, the premium. The premium is the cost of purchasing an option. It represents the sum of intrinsic and extrinsic values. What affects premiums? The premium is influenced by factors like implied volatility, time until expiration, and market sentiment. Higher implied volatility generally leads to higher premiums. When buying options, you pay a premium. When selling options, you receive a premium. Understanding the dynamics of premiums is crucial for successful options trading. Options can be used for speculation, allowing you to profit from market movements without owning shares. For example, if you believe a stock will rise, buying a call option can lead to significant returns. Conversely, if you expect a stock to fall, buying a put option allows you to profit from the decline. Additionally, options can act as a hedge against adverse market movements, protecting your portfolio from losses. If you own stocks and are concerned about a price decline, buying a protective put can limit your downside risk. Conversely, if you own shares and expect the price to remain stable or increase slightly, selling covered calls can generate income while providing some downside protection. Options can also be used to generate additional income through premium collection and other strategies. For instance, selling covered calls involves selling call options on stocks you own. You collect a premium and can profit if the option expires worthless. Another approach is selling naked puts, which involves selling put options without owning the underlying stock. It can generate income, but it carries higher risk. Beyond basic call and put options, there are more complex strategies that combine multiple options contracts to achieve specific goals. Vertical spreads, for example, involve buying and selling options with the same expiration date, but different strike prices. It can limit risk while providing potential for profit. Iron condors, a combination of a bull-put spread and a bear-call spread, offer a range of profitability with limited risk. Straddles and strangles involve buying or selling options with different strike prices to profit from significant market movements, regardless of direction. Options trading can lead to significant losses, especially if the market doesn't move as expected. Understanding the risks is crucial for anyone interested in options trading. If an option expires worthless, you lose the entire premium paid. While leverage can amplify gains, it also magnifies losses. High implied volatility can lead to higher premiums but also increased uncertainty. Options trading requires a good understanding of market trends, timing, and strategies. Misinterpretation or incorrect analysis can lead to losses. Successful options trading requires a grasp of market movements and trends. The timing of buying and selling options can significantly impact profitability. Exercise and assignment are critical concepts in options trading, with implications for both buyers and sellers. When you exercise a call option, you buy shares at the strike price, generally when the stock price is above the strike price. When you exercise a put option, you sell shares at the strike price, typically when the stock price is below the strike price. If an option is exercised, the corresponding seller is randomly chosen and assigned the opposing share position. When options reach their expiration date, their value depends on whether they have intrinsic value. If an option has no intrinsic value at expiration, it expires worthless. Options with intrinsic value at expiration are automatically converted into share positions. If a call option expires in the money, the holder gets long shares. If a put option expires in the money, the holder gets short shares. Some options, like SPX, are cash settled and do not convert to shares, instead settling at their intrinsic value. Stock options offer a flexible and leveraged way to engage with the stock market. They can be used to profit from stock price movements, hedge risks, and generate additional income. However, options trading involves significant risks, and it's crucial to approach each trade with a clear strategy and thorough understanding. Remember, the key to success with options is a solid foundation of knowledge and a disciplined approach. If you're interested in options trading, take the time to learn and practice before committing significant capital. Consider using paper trading or virtual trading platforms to gain experience without risking real money. Thank you for joining this comprehensive guide to stock options. If you found this content helpful, we invite you to explore more beginner-friendly investment guides on our channel. Share your thoughts and questions about stock options in the comments section below. Don't forget to like, subscribe, and share this video with anyone interested in learning about stock options and advanced trading strategies. Good luck with your investment journey.